Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Wolf Richter, publisher of WolfStreet.com. Welcome back to the show, Wolf.
Thank you for having me back, Jim.
What do you find is happening in the real estate sector in the U.S.?
We are looking at rising interest rates, and that will impact the real estate sector in particular because it is so highly leveraged. And that's not just housing, but also commercial real estate. And real estate prices have been pushed up very, very high in both sectors. So rising interest rates are going to have a very large impact on these sectors. Now, right now, the mortgage rate's around 30-year fixed mortgage, around 4.5%. If we continue to get interest rate increases, as I think we will, we may be looking at mortgage rates of closer to 6% by year end. And in the commercial real estate sector, borrowing costs will also increase. The Fed is getting out of mortgage-backed securities gradually, ever so gradually. That will also put pressure on mortgage rates. So, we're looking at a profitability issue in commercial real estate and an impossibility to buy in the residential real estate sector. And that means that, the affordability issue that we've been having in the United States for years due to the high home prices will get a lot worse due to the higher interest rates. And at some point, people won't be able to buy. And we've already seen pending home sales decline sharply earlier this year. And so I think we'll see continued pressure on them. I don't know that home prices will be impacted right away. I would suspect that will happen later this year or early next year. It takes a very, very long time for price declines to make it into the official statistics, because it just takes a long time to sell a house, to close on it, for this to show up in the statistics. So this is a slow-moving process. It doesn't go overnight. But I think later this year, early next year, we'll start seeing in many markets some price declines.
Do you think governments understand how much of the GDP is wrapped up in housing?
Yeah, they're all too aware of it, I think, and that's why governments have been, until very recently, around the world, very supportive of fueling real estate bubbles, because they see how important it is to GDP in a number of ways. The most important part is the construction sector, both in housing and in commercial real estate, which employs a lot of people. These are high-paying jobs. They're specialty jobs. The economic activity is local, so not a lot is imported except for some materials. Most of the expense is local. The people that get paid in construction, they spend this money locally. They buy trucks, they buy sandwiches for lunch, and they buy homes and other things. So construction has a very large impact on GDP. In some Canadian cities, it has, like in Vancouver, it has an outsized impact. Where housing construction is just a huge part of the economy now, and in other cities, other big cities, it has somewhat of a smaller impact, but it's still, it tends to be between 12 and 25% of in certain economies of the local GDP. So this is a huge chunk of the business, and that's why everybody wants construction. I mean, let's face it, and high home prices and high commercial real estate prices feed a construction boom, and that's what we've had. So, any turn in housing starts, and when housing starts start to decline, That's a real recession indicator. We have not seen that really. I mean, it's still a housing boom. It's still going on. But once that starts to decline, I think the broader economy will be impacted. Home sales and home prices themselves don't have that much impact on the overall economy, but construction does.
So as long as they're building homes at whatever price they're selling, that's the most important thing.
In terms of the economy, yeah, it is the most important thing is to keep building. The problem is that they're building high-end stuff, and they're very difficult to fill, so they're building high-rises now that are largely vacant, and both on multifamily and like apartments and condos, and that is not a sustainable business model. You can't just build buildings that are not being used, that don't produce an economic activity. So this will eventually stop, and developers, some of them will topple, and some of the buildings will go back to the banks because the units can't be sold or rented at these prices. So a building boom tends to turn into a bust after a while, and if overbuilding takes place, and even though there's a shortage on affordable homes, there is a big surplus of high-end homes, and the market knows how to fix that. Yeah, the market, if you let it do its thing, knows how to fix that in that, these high-end apartments and condos and homes, will enter a default process and will end up on the bank's balance sheets, and the banks will try to get rid of them, and they will do so at much lower prices and rent, and it will bring housing costs down if the market is allowed to do its thing, which a lot of times is not. So, in terms of construction, after a construction boom comes a construction bust. That's always the way it is, and because prices collapse, and then it doesn't make sense anymore to build all these things. So, and that's when the overall economy gets hit.
The BC left-wing government has brought in a 20% foreign buyer tax for most of the province. Was it necessary?
Well, I don't know whether it was necessary or not. You have Vancouver especially has a world-renowned housing bubble. It is really totally unsustainable. The Bank of Canada has not been raising interest rates as rapidly as it would be needed to curtail that housing bubble. And there's a lot of pressure on politicians to not completely block a whole generation from ever buying a home. So the housing bubble, when housing is used as a global asset class, there will be unlimited demand for housing because it comes from all over the world, and it's financialized and it's leveraged, and you can never build enough to feed that global asset class and the needs of the demand of that global asset class. And then the resulting bubble prices push out people that actually have to live somewhere. And it makes for a very out of whack economy when people with good jobs can't afford to buy even a starter home anymore. And this is not sustainable. Politicians have seen that, so they're trying to come up with methods to cut off the money flow from investors overseas that look at BC housing as an asset class that they want to invest in because they want to get their money out of China, and they want to invest in a country where the property rights are well established, and where they would like to have a foot on the ground in case something goes wrong in their own country. I mean, that's understandable that they're trying to do that, but that has become such a big thing in China. And every real estate company, every real estate brokerage in major one in Canada and in the United States, they have very active marketing programs in China, specifically trying to sell their housing stock to the Chinese investment class. And so that's a big business. And they're all proud of it, and they're doing it, and there's just, homes are not stocks and bonds. You have to live in a home. You don't have to live in stocks and bonds. So if they get overpriced, it's really no big deal. But when homes get overpriced, that's a real issue for people's lives. And so the governments are struggling with that. In the United States, the Fed has been raising interest rates and will continue to do so, and that will curtail the housing bubbles in some markets. But, in Canada, politicians have to choose other means, and I'm not sure it's the best way to do this, but it certainly is one of the ways to do this. And, of course, investors find millions of ways around things, and it may hit the wrong investor is going to hit Canadian investors, and it's going to hit Canadian homeowners, and it's going to have some other unintended consequences that are going to be somewhat messy, probably. So I'm not sure it's the best solution, but they're struggling to find a solution, and so I applaud them for trying. I'm not sure that they found out the other one.
Well, one thing Canada did institute was a stress test for new home buyers to see if they could handle higher interest rates. So they don't actually have to hike the rates to have the same kind of impact on them. So now they have to pretend that they're paying much higher rates, and can they still afford that house? Is that a good idea?
Yeah, so that's a different group of buyers now. Now you're looking at buyers that are struggling to buy a home with these high prices. And with adjustable rate mortgages that you have in Canada, banks are at risk when interest rates go up. And so, because the buyers are at risk. You buy a home today, your rate is 3.5%. 2 years down the road, your rate adjusts to, or 5 years down the road, it adjusts to a higher rate, and some of them are adjustable almost immediately. And you may have a much higher mortgage payment in the near future, and you may not be able to make that mortgage payment. So when you're already struggling today to buy that home, and your mortgage payment jumps by, $300 or $20 a month, you can't make it anymore, and you have to default on that mortgage. And now when that happens in large numbers, the lenders are at risk, and not only the home buyers or the homeowners, but the lenders. So I think when you have adjustable mortgages, it is prudent to make sure that buyers can afford the mortgage payments a few years down the road. With fixed rate mortgages, the lender takes there's really that you don't have that kind of risk. The risk you have is that you have a lot of inflation, and that the purchasing power of that mortgage is largely reduced. And that's a different kind of a risk that you don't have with adjustable mortgages. But in terms of credit risk, the lenders are heavily exposed there. So I think it's prudent and that should have been done a long time ago. The problem is now it's being done when home prices are so high, and when rates are going to rise. So this is going to put a lot of pressure on these buyers. Yeah, they're trying to find ways around it. They're going to try to buy homes, and they're going to alternate lenders, and they're going different routes, and they're playing games with it. And that shows you that we have reached the final stages of a housing bubble when you have everyone in the business trying to play games to still make this work.
We'll have more with Wolf Richter right after the break.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
Welcome back. We're speaking with Wolf Richter. Wolf, what's happening with car sales right now?
Well, in Canada, they're still holding up. There were some weak spots last year. So far this year, they're ticking up a little bit compared to 12 months ago. In the U.S., we have seen a slight tick up in January, and February was pretty bad. So that kind of destroyed the hopes for a major increase here this year. So this year will probably be another, in the U.S. will likely be another down year for the industry. It's early to say, but it most likely is. Prices are very high. Subprime auto lending has hit real problems. The subprime default rates of auto loans made in 2015, 2016, and now starting to in 2017 are defaulting at very large numbers. And this has caused the industry to get more prudent, which causes new vehicle buyers and some used vehicle buyers to have greater difficulty in buying cars. Now, on the new car side, there's really no place to go for these buyers. So when a subprime rated buyer wants to buy a new vehicle and the loan gets turned down, the dealer will try to make something work, and in the end, they will probably switch that buyer to a used vehicle that will cost a lot less, and they will create some paper equity on that, and they will try to get a loan done on an older car. If that doesn't work, buyers will switch to cash purchases. So they'll get some cash and they'll buy something for $1,000 or $2,000. And so the new car industry will lose those sales. They'll switch over to the used side, and they'll switch down the scale. And so you have quite a bit of demand in the 10-year plus sector, and that's already been fairly hot recently. Used cars in general are doing well, but on the new car side, I think you will see continued pressure, in part because the subprime customer with subprime credit ratings are not able to buy new vehicles anymore, at least not with the ease that they could before. And that's a result of banks taking, especially the specialty lenders that focus on subprime auto loans. There's a whole slew of specialty lenders out there that do that, and they have taken gigantic losses. And they're issuing these asset-backed securities backed by subprime auto loans. They're being sold as bonds. They're sold as they're sliced and diced, and some of the higher-rated tranches are sold with a AA rating or something like that. And the lower-rated tranches, they're now seeing some pretty big defaults, and that has caused lenders to be really leery. I think we're going to see some of these smaller specialized auto lenders. We're going to see them topple. There's a lot of pressure on that industry, and this will hurt new vehicle sales quite a bit. Now, subprime auto loans make up about a quarter of all auto loans in terms of balances. So, it's a significant part. It's not going to take down the banking industry like subprime mortgages did. It's not in the same magnitude. It won't do that. And it won't even hurt the biggest banks that much because they're not into that so heavily. It'll get the specialty lenders.
Are we finding any problems with hurricane-damaged cars coming on the U.S. market?
Yeah, they're out there. There are a lot fewer of them out there than we originally thought, but they're still out there. The range is now around 300,000 vehicles. Plenty of people are still driving the ones that were damaged and that weren't insured, and they're going to eventually try to sell them. Others have already entered the market. Some of them were salvaged. They have salvage titles, and they're being sold with salvage titles, flood titles. Others you don't know. So they're out there, and every hurricane has that. They're going to enter the used vehicle market and all over North America. And then some of them will probably drift south across the border, and that is a fact of life. If you buy a used car now, you need to be watching out because it may have gotten flooded in one of the hurricanes.
We'll have more with Wolf Richter right after this.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Wolf Richter. Wolf, what are you seeing in the retail business right now?
Interestingly, overall retail in the United States has been doing very well, and in the fourth quarter, retail sales were up 5.6% year over year. In January, they were up a little over 5%. In February, we just got those numbers yesterday, they were up 4.2% year over year. Now, the media presented this as a decline, and the media only looked at the monthly changes from January to February. But with retail sales, it's really kind of a squirrely thing, because retail sales spike in November and December, and then they collapse in January and February, and they do that every year. And the collapse from December to January is around 20%. So it could be 19% some years, and it could be, 22% some other years. And that's typical. They do that every year. That's part of the holiday season. And then in January, people return merchandise instead of buying things. And so you have this gigantic variation every year. And when you look on a seasonally not adjusted chart, it looks like the teeth of a shark. And so when the media publishes these articles on retail, they look at seasonally adjusted numbers. So they use large adjustments to level out the seasonal spikes and plunges during the holiday period and afterwards. And these seasonally adjusted numbers dropped slightly from January to February. But I think that's kind of a useless data point. You will look at it year over year, and year over year in February, retail sales were up 4.2%. That's not quite as strong as in the fourth quarter, so there was a reduction in growth. So that did take place, and from the fourth quarter of 5.7% to 5.2% in January, that's a decline in growth, but the growth is still significant. So what these adjusted numbers picked up is the decline in growth, but retail sales are still very strong. In fact, at 4.2% in February, they're stronger. The growth has been stronger than in prior years, so this is still above the average of the past few years, but not quite as powerful as at the end of last year. So, that's one thing. That said, most of that growth all of that growth came from online. And brick and mortar sales, and online means the sales not only of online-only entities such as Amazon, but also the online operations of established brick-and-mortar retailers such as Macy's and some of that, like Walmart, some of the other big ones that are really spending a lot of money on the online properties. On the brick-and-mortar side, we have a meltdown going on that is now the next one in line. The big one is going to be Sears. We had Toys R Us going into liquidation just yesterday after filing for bankruptcy in September. So they're going to just close all the stores in the United States and get rid of 33,000 jobs. They're going to disappear. Sears is reported its sales yesterday for its fourth quarter, its holiday quarter. They were a disaster. They dropped 28% from a year ago. Their holiday sales were flat with sales in the first and second quarter, which means that there was no holiday pickup. So I think Sears in the United States is on its last leg. Of course, in Canada, it's already been liquidated. So that's a retail reality. We have a lot of smaller chains that declared bankruptcy. Brick and mortar retail is in a very, very tough situation right now, even though overall retail sales in the United States are strong. It's really important to separate that. The Americans they're buying stuff. They don't have enough money, but they're borrowing it. So credit in the third quarter spike, and they use that money to buy stuff, but they're buying online. And they're buying it at some stores, and they're not buying at other stores. And, Sears USA Sears Holdings will probably not make it through this year. And if it makes it through this year, early next year it will be finished. And So that will be the next big casualty after Toys R Us. Among the smaller stores, it's been one after the other. Bon-Ton just filed for bankruptcy, and some others did too. So the brick and mortar retail meltdown, as I call it, that will continue. It has been going on for a little over 2 years. It will continue for many more years until the whole industry has restructured. I mean, this is a structural issue that has impacted the industry starting in the year 2000, and with online sales taking more and more sales away from certain retailers. The retailers that are under attack are department stores. They've lost, over the last 17 years, they've lost about a third of their sales. Music stores are already gone. Bookstores are, in the process of getting wiped out. There are small stores that are surviving, but it's an industry overall, they're in real trouble. And sporting goods stores are now getting hit hard. We've already had a big chain, the Sports Authority, go bankrupt. Now, Dick's Sporting Goods is starting to show problems. It's just one after the other. And so overall, people say online retail is only 10% of overall retail sales. And that's true, except the part that's impacted by retail sales, by online retail sales is a smaller segment of it. It's not the auto dealers. It's not the gasoline stations. It's not the restaurants and bars. Those combined that are online proof, that's over half of retail sales. The other half is under severe attack. And then we have a lot of retailers that have been bought up by private equity firms and have been loaded up with debt, and that includes Toys R Us, which is going into liquidation. And, when you have a structural change in an industry that makes it hard to survive, and you have over-indebted retailers, it's the over-indebted retailers that collapse first. And those are the ones, the PE firm-owned retailers are the ones that largely are collapsing right now. And that's an industry trend I think we will continue to see for the next few years.
Wolf, thank you so much for chatting with us.
Thank you, Tim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. If you have any questions for Wolf or any of our other guests, you can send them to info@housestreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.